Welcome back to CFA's 33rd Annual Financial Services Conference. Again, I'm Jack Gillis, Executive Director of the Consumer Federation of America. Today, we continue to examine ways to make the financial marketplace more equitable as the pandemic continues its tragic impact on consumer welfare. We're going to hear from Alice Rodriguez of JPMorgan Chase, Securities and Exchange Commissioner Caroline Crenshaw, and panels on the challenges facing housing policy and environmental, social, and governance investing. Before we dive in, let me again provide a bit of technology guidance. The screen you're watching will include the video feed for all of our speakers and panel sessions. The box below the video, Ask a Question, allows you to submit questions during the Q&A sessions. And the box labeled Audience Chat allows you to provide comments about the program. Please include your name and affiliation when submitting a question or a comment. Our Q&A moderators will pass on your questions to the presenters, and we'll do our best to get to all of them. Due to time limits and pre-recording, not all sessions will have Q&A opportunities. There's also a box below the video player where you can enable closed captioning for the program. If you are experiencing technical difficulties, you can submit your issue to us in the Ask a Question box, and our techs will respond to you personally. Finally, to the right of the video screen are tabs for conference materials, speaker bios, and a listing of our advisory committee members who supported this event. Please take a look at that tab, and we thank them for helping us plan this conference. You'll also see a tab for CFA's Twitter feed. If you'd like to interact with us on Twitter, you can use the handle @ConsumerFed and the hashtag CFAFSC. That's hashtag CFAFSC. To begin today's program, I had the opportunity to speak earlier with Alice Rodriguez of JPMorgan Chase about the company's $30 billion commitment to advance racial equity and what that actually means for the communities affected by systemic financial injustice. Here's a look at my conversation with Alice. It is my honor to introduce Alice Rodriguez. Alice is the head of JPMorgan Chase Community Practices, Engagement, and Inclusion, where she works in partnership with corporate responsibility to bring together business, philanthropy, and policy efforts to drive inclusive economic growth and opportunity for all Americans. She began her career in Brownsville, Texas, at the Texas Commerce Bank, but has spent more than 3 decades working with JPMorgan Chase, where she has held executive positions in business banking, consumer banking, and wealth management. Alice has received numerous honors, including Hispanic Lifestyle Latina of Influence. She's one of the Dallas Business Journal's Minority Business Leaders and a recipient of the Woman of Distinction Award from the Girl Scouts of North Texas. Most recently, she was named Chairwoman of the Board of the United States Hispanic Chamber of Commerce. We're particularly appreciative of you joining us today, Alice. Open communication is critically important as we work together to correct the financial injustices that are in this world. It can't be done alone or by one side or the other. So thanks again for being here. Let me just begin the discussion with the fact that while the pandemic has certainly exposed many financial inequities, they've all been with us for quite some time. What do you think is broken in our financial systems, and what do we need to fix first?
So first of all, Jack, thank you so much for having me. And I'm really honored, and I'm really glad to be a part of this discussion. And I think as you think about, the financial industry and what are some of the things that we should focus on, I think it really is understanding, who the consumer is to begin with. So I think that we are working with models that have been in place for more than the 3 decades that I've been in banking. And as you look at what the unintended consequences are from, either policy or business strategies or models in general, this is where you begin to understand that we're not always focused on the unique needs of the people in the community. And when you pause and take that lens and really start to understand, well, who are some of the people in the community that really are hurting and haven't had the opportunity to participate in wealth building? What is it that we need to bridge or focus on, whether it's product, marketing, etc.? This is where you start to get some real solutions going.
Well, clearly you and many financial institutions are rethinking this whole subject and how you use traditional financial tools to address the growing economic inequities. What is JPMorgan Chase doing to help with this problem?
So I'm really honored and proud of the organization, Jack, for announcing about a month and a half ago our $30 billion commitment to advance racial equity. And specifically what that means is that we're looking at all of the key drivers of wealth creation: affordable housing, our minority small businesses. We're looking at our workforce diversity. And we're looking at, from not just an affordable housing perspective, but actual lending and home ownership. And so as we've looked at the various segments, so for instance, when we look at wealth and the median net worth for a white household, it's $188,000. When we look at it for a Latino household, it's about $36,000. And for a Black household, it's $24,000. So you can see the huge gap. And again, we did a lot of research, and I believe we're very thoughtful over the summer and thinking through. So when you look at what are the key drivers of those gaps, like what is it in a white household that perhaps does not exist in some of the other two segments, this is where you see homeownership as being one of those key drivers. This is where you see, savings and long-term savings, the intergenerational wealth transfer that occurs in a white household that may not necessarily occur in a Black or Latino household. And we put specific strategies in place to deal with those. And more importantly, we established a lot of accountability amongst all of our lines of business to make this come to fruition. And I think that, I happen to work for a bank that is very outcome driven, is very focused on accountability. So really ensuring that each one of our lines of business understand what the needs are in the community, what we're trying to accomplish, and more importantly, that we're measuring it in a very disciplined way, I think is going to make a huge difference for us.
That's a lot of what we've been thinking about as well at the Consumer Federation of America. So the big question we have, and you're not alone in the major financial institutions starting to look at this, but what do you think is different about this major effort from the previous efforts by the industry to address financial fairness?
I think we're really embedding it in the DNA of the businesses. So if I look back over the last 3 decades that I've been in banking, whether it was, my own employer or others out in the financial services industry, I think there was always this view that we're going to solve this through philanthropy. And that's not bad, Jack. I mean, obviously, I'm not at all advocating that you don't do that. But I think what's different in the way that we're approaching it, and I also see other organizations doing the same thing, it's a recognition that it's not one thing. That, this has been perpetuated, right, over lots of decades. One might say, hundreds of years, right? And how do we as an ecosystem come together? Business, policy, philanthropy, like all in a very intentional way. And again, I think specifically what we're doing at JPMorgan Chase is saying we're going to embed this in the DNA of the business. And so in addition to all of the other things that the business does to move their business and to grow their business, we also want to be super intentional, or particularly around Black and Latinx, people, so that we're doing our part in understanding what the barriers are and what the challenges are, but more importantly, holding that business accountable to finding the right solutions.
What, as a practical matter, what would a member of a low-income community, an ethnically diverse community, what could they expect to see as a result of this?
Great question. So one of the things that, or one of the strategies that our consumer bank is deploying is we recognize that we have some great branches all over the country, wonderful branch managers, branch employees, but we also recognize that we have to have strong engagement in the community. And that requires really a business person to be out in the community, forming those relationships with nonprofits, building the trust of the community, and creating this this wonderful partnership that allows people to come into our branches, but more importantly, feel comfortable coming into our branches. And so we're deploying a new strategy where we'll have community managers that are going to do exactly what I just described. And I think that, you know, this kind of goes back to my earlier point about like really understanding and peeling back what are some of the reasons, as an example, that an unbanked or underbanked individual use alternative financial services as opposed to coming into a bank. Part of it is trust. Part of it is feeling like, I don't know that I am at the level to be able to engage in financial services, and being able to have people that are working alongside wonderful nonprofits who have built that trust in some of our minority communities, and getting them to a place where they understand what it is that we can offer, feeling comfortable about the guidance that we can provide. And more importantly, understanding that what we really want is just to provide that path for someone to get to anywhere from, you know, I'm starting my banking relationship and coming into the system, to that path to home ownership and then beyond.
Well, you know, obviously people like to work with people like themselves. And that means big banks like yourself have to have people like the people that you want to serve. One of the concerns that we have is that many of the big banks have moved out of the neighborhoods, have closed branches. What's JPMC doing along the lines of actually being physically present in these neighborhoods?
Yeah, we have had this long belief that our branches are very important, and as part of our Path Forward commitment, we've made a commitment to branches in our low to moderate income areas. We're also just looking at creative ways on how we can do a better job of reaching out to the community. So some of the things that we're thinking about are sort of a mobile bank that can go out to the people as opposed to people having to come into branches. And again, I think that part of the role that the community manager is going to have is really going out and working with nonprofits and their constituents to help people become more familiar with digital banking. So we're taking a lot of different lenses. We recognize how important that branch presence is. So we're committed to continuing to serve our communities that way. But we also want to look at innovative ways. And certainly with the pandemic this year and obviously the challenges with COVID-19, we recognize how important it is to also, you know, educate in our communities how you can use digital banking to be able to help you get through your day-to-day finances.
You know, this is obviously a huge effort you're embarking on. One of the concerns about industry efforts to address financial challenges of the underserved is the sustainability of those efforts. In other words, can companies afford to keep them going for as long as they're needed to actually create change? The incoming Citigroup CEO, Jane Fraser, has said that it can be financially viable to serve those on the bottom of the economic ladder. Do you agree that there's a business case for serving the underserved?
Oh, 100%. There's no doubt in my mind. And I've done a lot of work in the consumer bank to really demonstrate that it's very viable. And that is the goal here, Jack. And that's why, again, I think that what's critical here is that it is embedded in the business, because when it's embedded inside the business, you're going to be very thoughtful about ensuring that not only is it sustainable for the bank to continue to do whatever program or whatever product, et cetera, that they need to do. But it's also going to force you to think through, again, the customer lens and what we're looking for. And I know, like me personally, is that sustainability that you're talking about. We want to be very intentional about narrowing that gap I talked about earlier. And we believe that it's certainly, we can do that within the business. And our goal is to ensure that ultimately the customer wins.
Well, okay, as a practical matter, does this mean you all be incorporating some sort of management measures that are able to, you mentioned, how are we going to actually account for our success? Are you building in management guidelines that will incorporate the success of getting people into the system?
Yeah, so 100%. So the $30 billion effort that I mentioned earlier, I am currently leading the efforts to ensure that we have the right reporting, measurement, accountability, et cetera, to ensure that that happens. So you're right. This doesn't happen without being very intentional about saying we want to, we want to bring in a certain number of unbanked, underbanked into our banking system. We want to make sure that we are lending and we're creating home ownership for Black and Latinx people. And so all of this will be structured in a way where for every line of business, we understand the commitment. We get that commitment down to a local level. It gets into a scorecard, and then the management team, the leadership team, is going to be held accountable to it.
Well, that's good to hear. And I think that one of the big concerns we have as well, and as you know, we have a major America Saves program where we're really struggling with trying to get people to increase their savings. But the issue that many consumers face is that it costs too much to save, that there aren't any instruments available to them that will accept a $5 a week deposit or a $10 a week deposit or something just enough to get them over that now famous $400 barrier where many people don't have for an emergency. What are you doing in terms of the actual instruments that will open the doors to people who have so little funds?
Yes, so about 2 years ago, we deployed a new tool that we call AutoSave. And what it allows the customer to do is to systematically move money right from their checking account into their savings account. And what I love about what you just said, Jack, is that you're right. Sometimes it's those little actions that you take that allow you then to build that habit. And so with our tool, it allows the customer to save as little as $1 a day. And it has been just overwhelming the amount of feedback that we've gotten from people who say that has just been a lifesaver for them, because to the extent that they could save that $1 a day, that $30 really made a big difference. And so I think it's things like tools like that really help people to get the discipline and the behavior that they're looking for to be able to save.
Well, then there's the next level, and this is the level that I think is a number one concern to folks at the Consumer Federation of America. They don't even have an auto save account. They don't even have the ability to automatically save from anything because they don't have a paycheck maybe, or they don't have the instruments necessary to automatically save. How are we going to get these folks engaged in the system?
I think that one of the things that we have been very excited about in terms of this community manager and community center concept that we're deploying in our consumer bank is that it allows for the opportunity to invite people in to just start the discussion and to help them with the planning process. So you're right, Jack, like these times are very, very tough right now. We recognize that a lot of people have perhaps had their hours cut. They might have even lost their job. And what we want for people to see us as is a community partner. and that they can come into the branch just to have a conversation or participate in one of the activities that we have around just financial education. And whether that is just basic budget planning, whether it is maybe partnering with a community partner to understand what is available. Are there specific counseling services out there that people can take advantage of? So the idea here is to create a community center feel so that people are confident to come in to be able to get the kind of dialogue, guidance, assistance, at least referral to the right place, so that eventually they will get to a place that they're able to save.
We're so concerned about people who get into high cost lending situations, people who do payday lending, who do, rent to buy and all of these things. And what we find is that most of them are, for all intents and purposes, unbanked. They're afraid, there's a big barrier. And I guess maybe if you could explore a little bit or explain a little bit more how we're going to overcome that barrier and get these folks. First, you have to identify them, and then you have to get them into these facilities that you're talking about. That's a big job. And if we don't do that job, they'll continue to be victims of payday lending. They'll continue to pay way, way too much for a $500 emergency fee to get their transmission fixed. What are you, how are you going to get those people into the system?
I think this is where you have to be very thoughtful about what your marketing strategy is going to be, who your partners are going to be. And so we've actually done a lot of research on the unbanked and the underbanked. And I don't think this will be a surprise to you, Jack, but one of the number one barriers to getting them to come to a bank is trust.
Yeah.
It is trust. And the second is really transparency. They want to really understand what things cost. They don't want any, surprises. They can't have any surprises. But on the trust issue, this is where, again, I say that at least the approach that we're taking is, if we know that there's a trust challenge, then what are the ways that we can overcome that's a little bit different than the traditional ways that we have been marketing? So as an example, who are the key influencers in the community that can help us build that trust to then eventually, get them into our community centers, as I mentioned. The other is, again, the churches. In many communities, or the religious organizations, right? They have very big followings. And again, they have more, trust perhaps than we have with them at this point in time. And so it's just trying to be a little unconventional, maybe from the traditional ways that we've been, that we would think about marketing to a consumer and say, for this segment, if trust is the primary issue and the second is around transparencies, what are the things that we have to change in order to get that comfort level with these consumers?
Well, we strongly encourage you to use faith-based groups, groups that are very, very close to the community, because you're right. There is a huge trust problem between the unbanked and major financial institutions. There's reasons for that. A lot of them have had very bad experiences. A lot of them feel like they are disenfranchised, that they're not wanted in a financial institution. So, our message is to do what you can in spades that, open these doors and make people feel comfortable. And we think it's very important that like people serve like people. Let me just shift this a little bit, and along those lines, new products and new services, we think are very important. We'd love to see the major financial institutions enter the market with fairly priced loans to keep people from going into payday lending situations. So that's something we hope you'll consider doing. But moving away from what the industry is doing, We're here in Washington. We've been talking a lot about what you and hopefully many other people in your position in other big financial institutions will be doing. But what do you believe that the policymakers here in Washington, the regulators, and the new administration should do to improve the financial well-being of the underserved?
I mean, I think this is where partnerships are extremely important. And so leaning on the financial services experts to provide some insight onto what some of the challenges are. I think that obviously you have agencies like the CFPB that also have a pulse on what's going on. But I do think that, from a policy perspective, just looking at, what are the biggest levers that they can pull to ensure that they're also coming alongside all of the other things that are being worked on from the private side. So, I mean, there's I think there's already an agenda, Jack, of things that from a policy perspective that the new administration is going to be working on that are going to be, very positive. And I think that there's no question in my mind that affordable housing, as an example, is one of the things that I know is critical to the administration, given, again, all of the research around what's a key, wealth creator for individuals. I think that there's no question that thinking about the, maybe the regulatory oversight on a payday lender, as an example, or some of the fintechs that are out there providing some of the financing that you're talking about. So I'm hoping that the administration will focus on, obviously, those things that drive wealth creation and that are dealing with some of the really big challenges that our country are facing, and kind of put the housing piece in front of there, because there's just so much research out there that just outlines that this is a key lever that can be pulled to make a difference.
You are certainly correct, and that is certainly the philosophy of CFA. Housing is extraordinarily important, and there's been just enormous problems associated with denying people access to housing, and the button has just gone off, as you heard. So, thank you. I just really want to thank you, Alice Rodriguez from JPMorgan Chase. We really appreciate your insights, and we have great hope for the success of what you are doing. And who knows, maybe we'll work together to eliminate payday lenders and make housing more affordable and more accessible to so many Americans who've been denied that benefit.
Thank you, Jack, and thank you for all you do along with the organization. You're making a difference, and I look forward to that kind of partnership.
Well, you're welcome, Alice. And now back to our conference. Now we're back to our live feed. Moderating our next panel on the relationships between race, federal policy, and the housing finance market is CFA's own Director of Housing, Mitria Wilson-Spotzer, a noted expert in consumer protection, access to credit and capital, housing finance, and the oversight of financial institutions. Mitria, take it away.
Well, thank you so much, Jack. I am so thrilled about this panel. And one of the things that makes me most excited about the panel is that it's not going to be the traditional housing finance policy panel. We're not going to talk about race and how it relates to credit scores and how it relates to getting more housing counseling to communities of color. We're going to talk about the structural barriers that prevent people of color from accessing the housing finance market. And I think that's an important conversation because it's one that we often overlook. And so to start that conversation, I can't think of two better panelists to do it with me. On my left-hand side, I have Professor Carlos Chapman, an associate professor at Washington Lee University. Carlos would be shy to tell you this, but just this year, she was selected by the American Association of Law Schools as the Derek Bell 2020 award recipient for her activism and influence in advocating for social justice as it relates to not just communities of color, but all people, and making this society truer to its democratic principles. And then to my right on the screen, I have Jaron Levy, the Senior Director of Government Affairs at NCRC. But then again, she would probably be shy in telling you this, but she is also a former member of the Maryland Assembly of Delegates who represented Prince George's County for a number of years, and also served as a lobbyist and government affairs director for labor, in particular AFL-CIO, for a number of years, and has been passionate about these issues of economic justice and racial opportunity, and has left a mark in those spaces. So ladies, welcome.
Thanks for having me.
It's a pleasure to be with you.
So now we're going to have this conversation about race, federal policy, and housing finance. And I think that the way for me to start this is to start with the obvious. We all know that the racial homeownership gap has in fact increased and is at its largest levels to date since we've been recording it. But what I'm curious about is the fact that people actually that, right? There is this level of, oh my gosh, we have the largest racial wealth gap, racial homeownership gap that we've experienced in years. And so I want to set the tenor for this conversation by saying that this should not come as a surprise. In fact, if we look at the role that federal policy has played in housing finance, what we know for a fact is that not just for decades, but in fact, ever since the Homestead Acts were passed in the 1800s, federal housing policy has specifically preferred white borrowers, white individuals over communities of color, right? So we know that it was true with the Homestead Acts. We know that it was true with respect of the passage of the Home Ownership Loan Corporation. We know that it was true with the dissemination of the veterans benefits, the GI Bill, the ability of minority borrowers to access VA loans, even after they served their country. Even there, we know 1.5 million African-American individuals served in World War II. As a result of federal policies relating to veterans loans, only 30,000 of them actually were able to receive VA loans because of restrictive covenants and discriminatory policies enforced by the federal government. But I don't want to stop there. It's not just FHA and VA. We also know about USDA, right? And the Pickford cases. And we know that even into the early 2000s, you had the USDA systematically recognizing that it had a history of discrimination well up until the end of the 1990s against African-American borrowers, right? And borrowers of color writ large. And so given that backdrop, given the history of housing policy specifically favoring non-communities of color, first questions first, are you surprised that there's a racial homeownership gap?
Not at all.
No.
Yeah, Carlos, I'll let you jump on that first.
Yeah, I think we have this belief that housing policy is facially neutral and that, you're not allowed to discriminate any longer, in covenants and other things. And so that should have fixed the gap. But, I think what my scholarship focuses on is the impact of private ordering and the impact of corporations on our system. Mm-hmm. And, it's my belief that, in our system of federalism that prioritizes states' rights and individual rights, and in our system, especially post Citizens United and Hobby Lobby, where we are being more explicit about treating corporations like people and banks are corporations, which means banks are people. And, they've got the constitutional rights that you and I have. When you put all that together, and this comes through with Masterpiece Cake Shop and other cases, something that is illegal for a government actor or even for a business that holds a federal license or embarks in interstate commerce could be legal for an individual exercising their freedom of contract. So if I want to sell you my house for $1 as long as I satisfy my loan to my lender and my obligations to outside sources that are contractual, I can sell you my house for $1, even if someone over here wants to pay me twice the market price. That's my right to lose money and to opt for it. And so we can have racially neutral policies, but when we allow individual freedoms and rights to be involved and we start treating corporations like individuals, then of course we still have this gap. Because my bank can say, well, I think you're too much of a credit risk. Or my insurance company can say, this neighborhood is not safe, and so I'm going to charge you an unconscionable amount of insurance, which then makes it impossible, even if I'm a wealthy or middle-class Black person, to have the same things that someone who's white and has my same income level has. So it's not shocking at all when you think about the system.
Right. Gerard, you want to chime in?
Well, I'm really looking at, I'm in a community, Prince George's County, arguably the wealthiest Black county in the nation. I mean, not arguably, according to census tract data, 2010 census tract data. And, largely because, we have a lot of Black homeowners here. And I'm just looking ahead to what is coming. And, I have to be honest, I don't know. I think home ownership has really taken a hit. Not only is there a big gap, but in the popular mind for the next generation of potential Black homeowners or minority homeowners, Latino homeowners, home ownership has really taken a hit because I look at my own community, so many African Americans, so many, different communities of color lost ground after the crises, lost their home, lost their wealth, largely tied up in the home. And I just look at the challenges ahead and I wonder if we can even make it better because, and then, you've got all these millennials that are mortgage ready. They are ready to buy a home. They can sustain a mortgage, and yet they have so many barriers in the market in terms of finding something affordable and all of that. So my answer to your question, no, I'm not surprised. And I do feel like, we've gained a lot of ground, but at the same time, there's so many factors working against bridging that gap that I'm not surprised given the history. And I just think we have our work cut out for us going ahead, because for the young people who are entering the market now that look at what happened with their parents, we've got ground to make up just to sell to them that home ownership is the thing you should be doing. So anyway, not surprised. Great challenges ahead.
Yeah, and I think one of the things that I really think it's important to point out is that these challenges are not necessarily uniquely caused by dynamics in communities of color. And what I mean by that is that I think as we think about how we move forward with federal housing finance policy, we have to acknowledge that federal housing policy has been the instigator in perpetuating the disadvantages that relate to communities of color. And so, Carlos, to your point, it is very fascinating that we have adopted a policy of race neutrality. It is very fascinating that even within the incoming administration, there has been an emphasis on enforcing, preventing racial discrimination proactively, but not acknowledging the extent to which racial discrimination is itself a systemic component of the housing finance market. And allow me to say what I mean by this. We have to acknowledge the fact that generational wealth is in fact the predominant characteristic that determines access to home ownership and when that access occurs. And then if we accept that and we acknowledge it, then we have to accept the fact that the reality that people of color did not have access to home ownership in generations in the past means that they cannot provide that generational wealth that white millennials and other first-time home buyers are actually relying upon to have an advantage in the financial markets.
Yeah.
So then, to the extent that we say that we have a racially neutral housing finance policy that puts everyone on the same foot, we may be being disingenuous. And one of the things that struck me yesterday is Congresswoman Ayanna Pressley spoke. And the thing that she said that I thought was really profound is she said policy is not neutral. Policy is not neutral. And I thought about it in the context of our conversation today. Housing policy has been anything but neutral. And to the extent to which we have adopted an equality-based principle for advancing housing policy in the face of having racially specific housing policy in the past, can we honestly say that we are being racially neutral? Carlos, I kick the question back to you again.
You know, I think we can't. And, you know, I think about things like, you know, how we value real estate and the fact that we allow, I mean, yes, we have state tax authorities that value real estate, but, you know, when you're purchasing a home that is new construction or you're purchasing any home, you know, we say the market determines the value, but the market is racist. And so if I am buying a house in a Black neighborhood, that home inherently has a lower value than the exact same home that could be across the highway or across the railroad tracks or across anywhere else. And so if my home that I am investing my entire life savings and think I am building my wealth in is less valuable simply because I live near people who look like me, then how are we having a neutral policy when we're allowing the quote unquote neutral market, which is factoring in racism and the mere fact that you live near Black people? You know, I like the example of PG County because even though it is the wealthiest Black county in America, how much are the homes in a comparable white neighborhood worth?
Much more.
Right? How much more?
Big gap. Montgomery County is the neighboring county, and they're, in terms of the appraised value, property tax rates, you know, there is a significant disparity, and it always has existed. And also the recovery after the crises, they recovered faster. The appraised value recovered faster. I mean, there's a big gap in terms of the appraised value of similar homes.
What I love about this is if you put PG County on a spreadsheet and looked at all the things that should determine home value, proximity to highways, proximity to cities, the schools, you know, the amenities. In many ways, PG County is superior to the white counties that are further away from the city centers and that have fewer resources, right? There are things in PG County that are favorable to surrounding white counties, but the value of the homes is lower.
So Carlos, I would challenge you on that in one sense. I would say that one of the most interesting things about this, and your point is going exactly the right direction, but here's the fascinating thing about PG County, because I say this as a former resident myself, Duran and I know this, right? Is that you have this wealthy enclave of African-American individuals who are living in very wealthy households, right? And yet all the amenities and resources in PG County are actually consolidated in the lower income white neighborhoods remaining in the county. And so you have these wealthy enclaves of African Americans, but they don't have access to the same amenities, even though they have higher incomes and thresholds than their white neighbors. And again, this is a reinforcement of the impact of racially discriminatory housing policy and its effects. Duran, I don't know if you want to speak to that, but
let me tell you, this is a vigorous conversation in Prince George's County. I mean, if you talk to people here, I mean, they would talk about the schools and they would say, well, the schools are ranked lower in Prince George's County than Montgomery County or Howard County. You know, for a long time, we had a perception around crime in Prince George's County. I mean, they would point to various factors, okay? So it is and the amenities are coming around, I must say. But it is still this issue around appraisals and things like that, and insurance and all things like that are a real vigorous conversation. But yeah, you do have this. I mean, it's not a one-way conversation. It is a debate that has raged in the county since it became majority minority.
Right. I mean, and part of that is to Carlos's point, right? And part of that is to the broader point that we're talking about. Even when you have high income minority communities, you don't have the same property valuations. You don't have the same amenities. You don't have the same educational opportunities. And it's not just a question of those borrowers, right? Because we may be property tax paying individuals, but we can't force TGI Fridays to locate in the Black neighborhood as opposed to the lower income white neighborhood.
Well, I mean, and right, off restaurants, right?
Right.
It's just,
right.
We do get a certain type of amenities in the county, and in many cases, they are some of the highest grossing properties in the chain.
Exactly, and that's the point, right? So they actually locate in the minority neighborhood, and they have the highest production numbers writ large, and yet there still is this dearth of resources in these communities. And I think it speaks to the broader question of the impact of federal housing finance policy in establishing a track record of saying that these neighborhoods are inherently more risky and are inherently neighborhoods in which we should value investments less and value properties less. And so,
I want to add one more thing too, Mitria. While we can consolidate, Black wealth into communities like PG County, we can't force state legislatures to put more schools in our neighborhoods, and we can't force roads to be built to have better access to our neighborhoods. And so, I think about, I'm from Houston, I think about like Third Ward or other wealthy Black communities. It's like, yes, we have this consolidation and we have a good sense of community, but, how do we lobby the state to give us the resources we deserve?
Right.
In a place like PG County or a place like Third Ward?
Well, let me tell you, and I used to live in Houston too. I'm there almost every year. I have a lot of family there. I went to middle school in Houston, Southside Chicago too. I've lived in 3 of these big neighborhoods and did significant work in Atlanta. I've lived in 3 of these areas where you have significant Black population, significant Black leadership. And let me tell you, it is a debate every year. Let me tell you, in the state legislature, we had lots of conversation. Montgomery County, the wealthy county, white county next door that feels like they pay all the bills for the state, and Prince George's County gets all the money. It's a debate. It's a debate. A lot of the formula money in the state does go to Prince George's County and Baltimore City. In other words, what I'm saying is when you get down into the details of these fights, they are raging, and it's real, I think, you have a lot of legislators who are making the fight. It's just making progress on it is very difficult.
So to that point, we spent a lot of time talking about the problem. And so I've got to focus us on spending the next half of our conversation talking about the solutions. And if there are any, and what they look like. So, Jerron, one of the things that NCRC has focused on is utilizing the Community Reinvestment Act in particular as a vehicle for addressing the needs of underserved communities. And I know that NCRC has recognized that income by itself is not sufficient to close the racial home ownership gap. And so you've been pushing some very specific policies as it relates to traditionally underserved communities without regard to income. Could you talk about that real quickly?
Well, first of all, I would say this. I remember when President Clinton came in, he had a 100 point plan on home ownership. So, and you need the breadth of many things in order to really move the needle, I think, on Black home ownership. So CRA is a powerful incentive, but I always, tell people it only covers a fraction of the market. Mm-hmm. So, in 1993, 41% of mortgage loans were covered by a CRA review. So first of all, it only applies to banks, not the non-banks. And by 2016, it was about 30% of the mortgages even come under a CRA review. So both in terms of CRA and the affordable housing goals at Fannie and Freddie, they cover a fraction of the market.
Right.
Less. And, race comes in to some degree through the fair lending reviews, but it's limited.
So the emphasis on underserved communities, right? So the increase in 120% of area median income is designed to specifically focus on communities of color, right?
Right. But so, what the Federal Reserve has done in their CRA modernization effort, they've asked a great question. They've asked this question number 2 that is specifically looking at systemic inequity. And they've asked a question about systemic inequity and credit access for minority individuals and minority communities. And so, whenever you talk about race and CRA, you face market limitations, but also statutory and constitutional limitations. This is what you get back from the regulators and also the lawmakers.
Right.
That racial distinctions in the law can come under a strict scrutiny review. And so, they're resistant to put it in. Nonetheless, so we're answering number 2. And right. We're looking at this Federal Reserve's framework. And I just put up a paper yesterday, a blog post, about all of the places in which race is just a question you got to ask. Why not include racial demographics here? Why not track in your quantitative or numeric benchmark the number of retail loans, mortgage loans, why not measure, the numbers to minority households? Why not, better incorporate minority or communities of color, those census tracts in some of the quantitative benchmarks that they are proposing, and also the qualitative considerations.
And Jerron, to that
permanent way.
Yeah, so there you go. I want to get to this point, because here is, all 3 of us are lawyers, right? All 3 of us focus on the legal issues relating to this question. And I just want to bring up the point that both in the education and the employment sectors, federal policy has adopted affirmative action programs. We have never done that in the housing finance space. We have never established an affirmative obligation with respect to race specifically, not income, as it relates to housing finance. And if it's legal in the education space, right, and we can talk about the narrowing by the Supreme Court, but we also have to acknowledge that it is still legal to have affirmative action programs in education. And if it is legal in the employment and the federal contracting and procurement space, and we can also acknowledge the narrowing of the court of those interpretations, how is it not legal in the housing finance space, given that we know for a fact and can document for a fact that federal housing policy has systematically, by virtue of its own policy, discriminated against people of color. And the impact of that discrimination, even under racially neutral policies, is to deprive them of the same opportunities to access homeownership today. And I say that because one of the things that I think is really profound about this conversation is, and I kind of had this theme in my head, and it was like insanity is defined as doing the same thing over and over again and expecting different results. We've been employing racially neutral policies to address the discriminatory impact of housing finance for decades. The racial homeownership gap is what it is, right? The results speak for themselves. maybe the question is not that we just need to tinker around the edges and do down payments and those sorts of things, but that we need to address the issue of race head on and specifically. And what would that look like? So I'll leave that to you guys to kind of opine.
Well, I think the first thing we have to do, I think so much of policy is based on the idea of, 14th Amendment and equal protection, and we avoid use of the 13th Amendment, which is about badges and incidents of slavery, just to shortcut it, right? And I think when you think about badges and incidents of slavery, you acknowledge that Blackness is different even than of color. And that when you use things like income and other things as a proxy to address that underlying racial discrimination, you're always setting yourself up for failure, right? Like you're always setting yourself up to not properly address it. And so, we've already discussed how Black people with the same income have less wealth, how, Black people who spend the same amount of money on their homes have them appreciate at a slower rate. And that can't be addressed by a racially neutral policy when so much of racism is behind the reason why. We've got to look at, racism and to an extent anti-Black racism is the reason for so many of the discrepancies.
Jerron, do you want to weigh in?
Well, I think we have to, I think that's what why the Federal Reserve asking this question. We've put up a number of queries. Why not affirmatively explicitly include these here? And we're just going to build that conversation. We're going to make the case, build the conversation, and see how we move that conversation ahead. So, that's the approach right now. We've identified that these are the places, and we're going to build the legal case, and maybe the 13th Amendment. We look at how we can build the case that, you can do this, that regulators can do it, and the law will support it, and it can be sustained against an equal protection legal claim. So move the conversation ahead and, bring people along with it. Hopefully.
Yeah. And I think that's, so, both of you have raised really important points. We think of the 14th Amendment and the Equal Protection Clause as prohibiting race-favored policies and programs, but that's not true, right? It does not prohibit race-favored programs when they are specifically targeted to ameliorating past harms based on racial discrimination. And we need to remember that, right? And so this notion of the notion that race neutrality is required by the law is not accurate. And again, the education and the employment sectors reaffirm that. But to this kind of broader point, the Biden administration has released its housing plan. And I know I circulated to you guys a little bit earlier, and I just thought I wanted to get your thoughts. So if we see under the Biden proposal, they say, look, we are going to have stricter enforcement of fair lending laws. Mm-hmm. We're going to have stricter enforcement of fair lending laws. We are going to have stricter enforcement of the Community Reinvestment Act, Jerron. Mm-hmm. We're going to make sure that financial institutions, not just financial institutions, but non-bank financial institutions are subject to the Community Reinvestment Act. We are going to establish a tax policy that specifically relates to providing a tax credit for down payments. And so I want to ask a slightly provocative question to you. So if all of these things happened, right, in this administration, do you think that we would close the racial homeownership gap?
I say no. I think it's a start. This is to enforce what we have and to use what we have, and in many ways to grab the low-hanging fruit, right? Assistance with down payments and enforcing the things that are on the books that we've spent 4 years reversing. Mm-hmm. It's a great place to start. I don't think this is a solution. There's so many more elements that weigh into the gap. that simply enforcing these policies on the books and simply having these structures in place is just not going to be enough, because we've seen that it wasn't enough in past administrations. You know, we've got a Clinton administration and we've got an Obama administration that did these things or started these things. And the gap just grew. And when the market crashes, you know, people of color are still impacted more when there's a market crash. So we've got to think outside of the box and coming up with a solution. You know, it's like what you said about the definition of insanity. We're doing the same thing.
I see you were thinking. I saw your hands go up. I know you've got something.
I mean, you know, there's so many moving parts, right? I mean, obviously, we've got this pandemic raging, and what that looks like on the other side for Black home ownership, it's just, you know, hard to envision whether we can preserve what we have so that the gap doesn't get greater. But also, I think there's just so many pieces to it. So I don't think that those things alone would close it. Would it make progress? Yes. Okay. It won't close it entirely. It would make progress. It would, you know, move, you know, it makes some progress. That's just the bottom line. Right. But in terms of closing it entirely, there are just too many pieces to that puzzle. And so,
So I'm really glad that you both said that, because one of the points that I wanted to make in this conversation is that you can tinker around the edges of housing finance policy, but until you address the structural inequities in housing finance policy, you will never be able to close the racial home ownership gap. But I want to address the question that we got through the group chat, and it said, what about CRA incentives to promote more integrated neighborhoods, not specific as to any particular race? And this actually brings me to a question that I wanted to raise with you guys that is related to that, and that is the use of income as a proxy for race. Mm-hmm. Does it work? To the extent that housing finance policy has actually looked at equity-based solutions, they have been income specific. And yet what we see is that in low and moderate income designations, the home ownership rates for low income white households are 60%. For minority households, both African American, Latino, the number is somewhere around 30%. And so we've had the Community Reinvestment Act, we've had affordable housing goals that are based on income specific criteria, and yet that doesn't seem to be closing that gap in meaningful ways. And Jaron, I know part of what NCRC's advocacy is to say, look, by itself it can't. And so, could you speak to that?
I mean, to the question, I would say that both the affordable housing goals and CRA they do encourage, as it is right now, economic integration that the questioner is asking about. In fact, it's a bit of a controversy in CRA that perhaps it is encouraging too much. It borders on gentrification in some regard. So I will say that right now, today, there are middle, upper income folks who are purchasing, there is some economic integration pieces to both CRA and the affordable housing goals. And so, the racial part of that is a different question, but I will say that the law right now and the way it is working, that is occurring. In fact, there is a real dispute about whether it is too much, it's gentrifying some areas in some cases. So I want to deal with that issue.
Yeah. So I want to talk about that, because one of the most fascinating things to me is when a federal housing finance policy actually uses income as an equity-based perspective. The way that it does so is to say, look, we will increase the income level of the individuals who are able to buy in communities of color. Yeah. So the result is, to the extent that people of color, who, by the way, first-time home buyership purchase rates, you have a third of white borrowers actually borrowing at the age of 25. You don't get to that same number for minority borrowers until they're in their 30s, right?
Yeah.
And so the point is simply this: if we know what we know about income, you make a lot more money in your 30s than you do in your 20s, right? So your income gets higher. And then if we know anything about income stratification and volatility in the United States, we know that low-income minority borrowers don't have access to home ownership in the same way that white borrowers do, because their incomes are far more volatile and they make far less money in that low-income spectrum than their white counterparts do. And so home ownership, when you talk about communities of color, really is focused on moderate and higher income communities. So I raise that question to say, if we have an income-based system that says, look, we'll increase the income designation, but that designation is limited to communities of color, Carlos, how doesn't that reinforce the notion that people of color benefit from these systems only when they can purchase in communities that are racially segregated and then face the same questions about property valuation and appraisals and so forth and so on?
Well, I mean, that's exactly what it does. And I would like to just, talk about a little more about why that age of first home purchase has such a disparity. Some of it's down payments, right? Like if you don't have intergenerational wealth, you don't have parents who can write you a check for your 10% down, or even the 3% down. That's the FHA. Like that's still a lot of money to a lot of people, having that much cash disposal, especially, if we want to talk about education, when you figure how much more people of color are borrowing, especially Black people, to go to college and get the incomes that are higher, or how much more debt they go into and how much more consumer debt they have, and because they don't have access to high quality credit. And so when you are using income-based policies and saying it's allegedly neutral, and you're using income as a proxy for race, you're just reinforcing the system. You're not making acknowledgments or fixing the system at all. In my opinion, you're not doing it. And so you think about why it is that we end up where we are as our starting point. Why is our starting point different than a quote unquote equal white person? And to get to Jerron's point about the gentrification, when we have these income-based programs and we have these other programs that are meant to increase home ownership, well, if I can get some sort of incentive for moving into this neighborhood based on my lower income level, that's not something that the people who already live there are going to have access to necessarily, right? Like if there is an incentive for almost cultural erasure or displacement, the idea that, if you just bring more people in or bring higher income people in, then, that makes it better. That doesn't work if the people of color who want to be in that community don't have access to the resources.
Jerron, it seems like you wanted to chime in.
Well, I think Carlos really covered it. I will say that, and this is kind of off topic, the affordability challenge, what people can afford to buy and whether they have affordable inventory in their area is proving to be, it's not just the access side of the equation. More and more, like for all these mortgage-ready millennials, Black millennials, it's like over 2 million, 2 million of them, they don't have something that they can purchase in their area that they can afford. So anyway, I just put that on the table. That is going to be a significant mountain we have to climb in the coming years.
For our last question, because we're down to our 5-minute warning, but I have so enjoyed talking to you guys. It's been awesome. So I wanted to raise a question that was posed by the audience, and the question is as follows. It says, it has been explained to me that the constitutional issue is most problematic when you are compelling private actors to behave in a race-specific way, as in the CRA context. And so I believe the question is, what are your thoughts on that statement?
Mm-hmm. Well, compelling private actors to act in a racially specific way. I mean, the bottom line is that there are many ways within this framework that the Federal Reserve has proposed where race could be included in some ways far more compulsory. So if you include it in the numeric benchmarks, the weighted averages, and all of that, sure, it can be more compulsory. But there are plenty of ways that race can be included that are not as compulsory, but just require that all of us look at the data, just factor it in. You have 40% of the community is, Black. Okay. Mm-hmm. So if you're tracking everything else by income and everything else, why, there should be a tracker on that too. I mean, why isn't that on the dashboard? Why isn't that a data point you're tracking as you are examining this private institution? So yes, how compulsory you can get in terms of an equal protection analysis is a question we're asking as well. But there are plenty of ways that aren't as compelling that it can be included. You know what I mean?
Can I be antagonistic on this one, Jerome?
There's a cudgel approach, yes, but there are lots of other ways where it can be a part of the analysis, just a bit shy of the cudgel.
Yeah. Can I be antagonistic? Because I would actually challenge the question. And here's what I would say. That presupposes that private actors in the housing finance market are acting independently of federal programs. The reality is what we know about the housing market is that it is a heavily federally subsidized market. So if you are making FHA loans, if you are making loans which you sell to Fannie and Freddie, you are not just a private actor. You are a private actor that is benefiting from federal programs. And if you are suggesting that federal programs don't have the ability to address racial inequalities, specifically racial inequalities that are tied to their own previous policies of discriminating, then I think that is a mistake. Because the law specifically does allow them to do that. And so one of the things that I would suggest to the question holder is that we're not talking about a private market. We can talk about private label securities. We know they're a very, very small portion of the housing finance market. We need to understand that most of the federal housing finance market that operates in the United States today is in fact federally backed and federally subsidized. And so there isn't the notion private actors are benefiting specifically from those federal programs. And we have every right to expect that those federal programs ensure that they enact policies that specifically address the needs of communities of color.
But the bottom line is, can it get past the Supreme Court? I mean, we can make a case, but the question is, once we go into court with it, can it survive? And that's really the challenge. I mean, we can demand it, but whether we will be able to sustain it is really the question.
Yeah.
So I disagree with Nutria that there's an over application of the word private, right? Like there was a time when we were much better at acknowledging when people are using federal resources and when the government is subsidizing and encouraging things. And just because it's a private entity doesn't mean they're engaged in private activity. And that's a distinction that I think we've gotten away from.
Well, I mean, that's the whole premise of CRA and the affordable housing goals. You're benefiting, these are duties to serve. These are affirmative obligations imposed because you're getting the benefit of deposit insurance, because you're getting access to a secondary mortgage market, because there is a federal apparatus from which you are benefiting, and therefore we are imposing an obligation. And so the question is, can it be a racial, can there be a racial distinction?
Man, I could talk to you guys about this for forever. I know you know that I could because I have private conversations, but we're actually at our time. And so I want to thank you so much, Professor Chapman. I want to thank you, Jerron, the Senior Director of Government Affairs for NCRC. Like I said, I could talk to you guys forever about this, but I hope that this conversation was illuminating for our participants and the individuals who had the opportunity to be there. And then also thank you to the audience for all of the great questions. I know that we weren't able to get to them all. I'm sorry about that. I promise hopefully we'll have another opportunity in which we can address them. So going up next, we're going to take a little 5-minute break and then move into our next panel about whether ESG investing will promote a more productive and inclusive economy. And I just want to thank you guys again for joining us and thank you for this awesome conversation.
It was really a
So
pleasure.
good to see you, even virtually.
Yeah.
Both of you. Bye-bye.
Hi.
Thank you again, Mitria Wilson-Spotzer, Carlos Chapman, and Jerome Levy. As a critical key to wealth building, nothing could be more important than ensuring fair access to housing for all. And these three women clearly outlined what systemic racism is all about. I'm hopeful that others will join us as Mitria marshals CFA's efforts to address this tragedy going forward. Next up, we'll have a discussion on whether ESG investing will promote a more productive and inclusive environment. Moderating this panel is Heather Slavkin-Corzo, the head of U.S. policy for the United Nations Principles for Responsible Investment, the world's leading proponent of responsible investing. Welcome, Heather.
Thanks for having me on. And thank you guys so much for having this panel today. And thanks to the audience for being here. I'm really excited to have the opportunity to talk to all of you about this important issue and to be joined by a really great set of panelists. I have with me today James Andrus, who's an investment manager in board governance and sustainability at CalPERS, Chris Fidler, the Senior Director of Global Industry Standards for CFA Institute, and Adam Kanzer, the head of stewardship for the Americas of BNP Paribas Asset Management. So really excited to be here talking to you guys. And we're going to start off with each of us making some opening comments. And so I'm going to begin by just talking a little bit about ESG and what ESG is. So essentially, ESG stands for environmental, social, and governance. And it's a way of engaging in investing that's all about trying to integrate issues like climate change and inequality and human rights and board governance into your investment practices. And these are strategies that are undertaken by pension funds, by mutual funds, and increasingly by all sorts of asset managers and investors around the world. And initially, I think in the US, we were really thinking about ESG investing as a way for investors to mitigate risk in their portfolios. So if you think about it, if you're investing in Miami real estate, you may want to think about rising sea levels as you're making decisions about your investment practices. You may want to think about fossil fuel and the standards around fuel efficiency as you're thinking about the impact and the future of your investments in fossil fuel companies. And so that's really the origins or a lot of where ESG has started, but it's evolved now, and increasingly people are talking about ESG investing as a way to try to channel private assets into more positive, productive uses that can be used to address things like climate change and inequality. So if you think about the President-elect's Build Back Better plan, his goals of trying to eliminate or try to decarbonize our economy or try to address racial injustice. And all of this requires investment, and ESG investment practices can be used to channel private sector investment in ways that help achieve those public interest goals. And so I'm, again, excited to be joined by our panelists here. I wanted to kick it over to James first, so you can talk about how you do this at CalPERS. How does this work day to day?
So thank you very much, Heather. At CalPERS, we have investment beliefs. Those investment beliefs call us to focus on three things. Those are financial, physical, and human capital. And with those as guides, we are focused on long-term investing. We are a $430 billion pension fund with liabilities that run decades, and the need to produce returns at 7% per year. Sustainability is incredibly important. That means to be able to consistently make those returns year after year. If bad things are happening in the short term, they will actually prevent us from being able to make money in the long term. ESG has a long history. In fact, the history is so long that at CalPERS, we are moving to call it sustainability and focusing on sustainability. ESG, as you note, environmental, social, and governance, when it's usually talked about, there's a focus on the E and the S. It includes things like forcing Greyhound to diversify its buses, allowing LGBTQ people to actually have jobs and not be fired because of who they happen to be. It includes worker treatment in both public and private markets. It causes us to ensure that companies and managers obey human rights. Because if they do not, it may provide a short-term return on a particular project, but it makes infrastructure financing, for example, more expensive throughout the entire market. So at CalPERS, we do a number of things. On the environmental side, we're instrumental in forming Climate Action 100+, where we focus on the largest emitters around the world. Those 100 emitters produce more than 50% of the carbon output. So we focused on those. Human capital is critically important. And in that context, we're focused on the proper treatment of workers. We do this through certain things such as the Responsible Contractor Program, which we use in our Real Assets program, and a focus on corporate reporting about employees. Most companies make a global statement about how important their employees happen to be. Some go as far as that also includes diversity. Unfortunately, what we found is that the actions don't always mirror what the communication happens to be. And so, but we want it to. I mean, so basically, if the statement is important enough to the company, we want to ensure that the company complies with whatever those statements happen to be. And finally, we're very focused on the F, those financials. But when we focus on those financials, we're focused on investor rights. And those are the things that investors actually find important because we think it has a long-term impact on the viability of the companies and of markets. Thank you much.
Thanks, James. And now I want to turn it over to Adam. Adam, you're engaging in ESG investment strategies day to day for a major financial institution, a major global financial institution. How does this work for you all in practice?
Sure. Thanks very much. So for everybody, this is an enormously complex field that I have to say the practitioners, and I'm one of them, have probably made even more complex for the general public. So you're going to hear a whole range of acronyms. You're going to hear a whole range of terms that may not make a whole lot of sense to you. So I think we're going to try to do our best to kind of decipher some of this and make it seem more sensible. And that's not a criticism of James there. We all do. It's this ESG in itself. I mean, what is ESG, right? So let me take a quick step back and just give you a sense of how we think about this. So BNP Paribas Asset Management is the asset management arm of BNP Paribas, the French bank. We manage roughly $500 billion globally in a wide range of assets. We're in most markets around the world. And we do have a core commitment to sustainability. We published a global sustainability strategy. We've been doing sustainable investment for a long time. We published really our first kind of roadmap for how we're thinking about sustainability last year, a global sustainability strategy, which is on our website. And we identified what in that strategy. I mean, we said things like, we're going to align all of our portfolios with the Paris Agreement. We're going to integrate ESG factors into all of our investments globally, all asset classes. It's really a very strong commitment. But what I want to focus on here is kind of the intent behind that commitment, and some of the basic components without boring you with, how does portfolio management work? I've always thought, I've been with BNP for a couple of years now, but I've been in the field of sustainable investment for a little over 20 years. And I've seen it grow and I've seen it change. And I think we're kind of at a stage now where it's fair to say that it's mainstream. Every major asset manager has some commitment to either, they use different terms. They might say ESG, they might say sustainability, they might say responsible investment. It's all kind of part of the same basket of ideas. And the basic idea behind it is that environmental, social, and governance factors affect returns primarily in the long term, but also in the short and medium term. And if you're a prudent investor, you want to take those factors into account in your investment process. You may do that in a lot of different ways, but that's sort of what it is at its core. How do you think about that? And just simply doing that sends a signal to companies. It sends a signal to the capital markets that says these things matter. So it creates a demand for information. It creates a demand for companies to start disclosing their greenhouse gas emissions, for example, or their human rights policies, which was not common 10, 15, 20 years ago, but is now becoming very common. So we can now measure, we can now really think about who are the real leaders and who are the laggards. And we can use that as a mechanism to try to advance them. Let me take a quick step back. I sort of jumped ahead of myself. In our strategy, we also outlined 3 broad themes that we see as preconditions for a sustainable economy going forward. And those are, we call them the 3 E's, the transition to a low carbon economy, environmental sustainability, particularly with a focus on deforestation, and we're moving that into focus on biodiversity. And the last one, which is really kind of the theme of this conference, I think, is equality and inclusive growth. We see these as broad systemic themes that both obviously impact society, but also impact our investments because they impact society and because we're broadly diversified investors. We carry that through in terms of our portfolio management, and that can be done in wide range of strategies, from underweighting or overweighting companies based on their sustainability characteristics, to thematic funds that focus on specific themes, to excluding companies due to poor practices. My role is in stewardship, so that's voting at the annual meetings of companies on things like the board, on executive compensation, on shareholder proposals, engaging with companies on sustainability issues, including the submission of shareholder proposals, and public policy. And I think those are kind of the broad components of it. And I'll just close by saying, so all of us use these, many of us use these factors, but we use them for different reasons. And for many investors, it really stops at, well, we believe that this might impact performance, and so we have an obligation to do that. It's pure risk management. For others, including us, and I know including CalPERS, we're concerned about the impact. We're concerned about the impact of our investment decisions on society. We're seeking to also move things in the right direction. The way we phrase that is that investors can be future takers. So you try to understand what's coming up around the bend, and as a good fiduciary, you want to understand that. Or you can be a future maker, which is acknowledging you have a role to play in the system and seizing hold of that and really trying to take that role. So we see ourselves as future makers. And I'll stop with that and give it back to Heather.
Thanks, Adam. So Chris, one of the points that Adam made is something that we at the PRI spend a lot of time thinking about, and that's this idea that we're now increasingly seeing mainstream investors talking about integrating ESG factors into their investment practice. We just saw the Investment Company Institute, the major organization that represents mutual funds in Washington, D.C., come out and call on the SEC to adopt mandatory ESG disclosures for public companies. This raises a question that I want to ask you, Chris, and that's like, how do we make sure that this is real? Because a lot of what we hear, that there's a term in the industry that we call greenwashing, and that's basically people saying warm and fuzzy things to make us feel like we're investing in ways that will have positive outcomes, but in reality, there's nothing there. So, Chris, how do we make sure that there's there? How do we ensure this is real?
Yeah, thanks, Heather. That's a great question. And first, let me say that CFA Institute, its mission is to be a leader and champion professionalism in the investment management industry. So I think fundamentally where we would need to start is around ethics. Okay? It's this question of greenwashing or any other kind of washing is really a matter of positioning a product to have more benefits or different kinds of benefits than it actually does. So we need to start with an ethical foundation. And that is something that CFA Institute provides in its Code of Ethics and Standards Professional Conduct. That is our code that is required to be signed by all of our members and all charter holders. And part of those code and standards is a duty to clients to be forthcoming about the nature of the strategies that they offer and the type of advice that they offer. So now I think if you start with that foundation, you would then need to extend that a bit to, well, how should certain situations be handled? Because I think certain, reasonable people could have reasonable differences of opinion about the depth or the scope of those disclosures, or even terminology being used. That's another one of the I think challenges out there, as kind of Adam alluded to, is there's a lot of different words and terminology, and it's difficult to sort through. So one of the things that we're working on at the CFA Institute is a standard that would help investors, regardless of what their interests are, be it more financial, be it matters of environment, matters of equality and social issues, whatever their needs may be, to help identify the products in the marketplace that would meet and be suitable for their particular needs. And so that is, I think, one of the things that is really needed to, prevent this sort of overclaiming of products, is just a clear communication standard that allows, asset managers a level playing field, right, and to disclose their products and have investors understand them on equal footing. And I think that's the best way to make sure that really investors get what they're looking for, and not something that they're not looking for.
Yep, all really good points, and things that we're hoping the U.S. will also have the opportunity to advance on from a public policy perspective in the coming years, because Europe is really starting down this road already, but we've been falling behind here in the U.S. So I want to turn to a question about some of the potential impacts or some of the shifts that we've seen and progress that may or may not have been made on ESG investing in the last few months. And one of the things I wanted to start with you, James, on is a question about, whether you've seen some shifts in response to the pandemic, in response to the murder of George Floyd or other racial justice issues that we've seen over the last few years. Has this changed, do you think, the nature of the conversation around ESG investing?
So we're actually having two conversations. One is a regulatory conversation where the recent months or the most recent years have shown an anti-regulatory bent, which actually makes it less likely that we would see ESG-related items in formal regulatory disclosures. But I think your question actually is on, are there other events that actually impact where we are and where we're going with regard to ESG? And the answer is definitely yes. The pandemic shows that we definitely should have a larger concern for the workers in the place and society as a whole. Without a functioning society and without treating workers well, we're definitely less likely to be able to reach the long-term returns. So these are definitely financial issues. And we see some things that are quite troubling. I mean, I think one thing, PE Stakeholder has recently done a study on the number of managers that have moved to evict tenants during the pandemic. The CDC imposed a moratorium, basically saying it's illegal to evict anybody during this particular period from August to the end of December if certain requirements are met. Basically, the tenant has to complete a declaration. Over 20,000 evictions have been started, and that's of the last reporting, and more likely than not, there are substantially more. So when you start talking about a pandemic, it appears that some people, even managers who are very highly paid by us, pension funds and the like, have disregarded, if not the letter of the law, the spirit of the law, and have moved to evict, regular people. I think this makes it harder on a going forward basis to operate in spaces where we have to then have additional due diligence items to make certain that not only will the managers follow the letter of the law, but the spirit of the spirit of the law, and actually consider human rights and worker rights in making these significant types of decisions. I mean, so with regard to George Floyd, there is a definite need to think more so about diversity. I think one of the big outcomes has been a definite increase in the number of racially diverse people who are being placed on corporate boards. And the interesting thing about this is, prior to George Floyd, if you look at American corporations as a whole, more than 50% of the 3,000 largest corporations, or at least publicly traded corporations in the United States, had no racially diverse people on their boards. But that is in fact changing, and there has been a substantial increase in the number of board members of the boards of directors who are in fact racially diverse. NASDAQ has recently come up with a plan that would further promote racial diversity by requiring it as a part of being a part of the exchange. So we see that from a regulatory perspective, there's been a movement in the exact opposite direction from what we seek. But because of events in society, the pandemic, and George Floyd, Breonna Taylor, and others, we see a social movement that has actually created change. But it's important to note that this is outside of the regulatory aspects, which have been moving in an anti-regulatory faction, in an anti-ESG manner. So the hope is that going forward, we can bring regulations in line with a thoughtful ESG approach, an approach that is more consistent with what society wants as well.
James, you raised some really good points. I think one of the things that was so sort of surreal, I mean, there's been so much that's been surreal about our experiences in 2020. For me in my professional capacity, one of the things that was pretty surreal was that at the same time as the regulators in Washington were making moves to make it more difficult for investors to integrate ESG factors, my phone was ringing off the hook, getting calls from investors who were saying, what can we do to get more information about human capital issues, about racial justice issues, about board diversity? Because they were increasingly feeling the need to have that information, to make it part of their investment practice, at the same time as government was making it more difficult for them to do that. So I want to bring it over to Adam. Adam, how did you guys at BNP Paribas, how have you navigated these issues, and has it impacted your investment practice at all over the last 6 to 8 months?
Well, let me focus on the stewardship piece, because that's sort of closest to home for me. But a couple of things. I mean, one, I think because we take a holistic kind of systemic approach to thinking about these issues, I think it's a little bit more natural, because we're talking about systemic risk all the time, and then all of a sudden you're living through one. So and we've been talking about workforce issues and the S in ESG for a long time, and working on those issues for a long time. But yeah, this is different, right? And we spent a lot of time over the course of the past year, and we work very collaboratively with other investors. So there's been a broad conversation among investors in the U.S. about how to think about this. And a few things I think have come to the front. First off, as James made very clear, the workforce has really been absolutely front and center in investor dialogues with companies over the course of the past year. We've been having conversations both in terms of precisely, specifically, what are you doing to ensure that there's social distancing in the workplace for frontline workers, for providing personal protective equipment. What about your supply chain? Are you ensuring that that's happening in the supply chain as well? There's been a lot of dialogue about those issues. How do you measure that? How is the board overseeing that to understand that these practices are actually being put into place and that they're actually working? I mean, the thing that I think has been made crystal clear is that inequality is a question of life or death. We're all privileged enough to be able to work from home, for the course of the pandemic. It hasn't been that much of a hardship, to be honest. There's the fear surrounding it, but for executives, for those of us that are able to work in front of a computer all day long, we're pretty safe. But we're investing in companies that have very large frontline workforce, and these people don't have the privilege of being able to sit at home and stare at a computer. So their interests has really been front and center. The thing that I've been focused most on is thinking about ensuring that you don't waste a crisis. What can we learn from this? What were the gaps in the systems that were exposed by the pandemic? Because honestly, every system I can think of has gaps in it and has problems, and the pandemic exposed all of them, right? It's that's sort of just the nature of how systemic risks work, I think. So I've been having a lot of conversations with companies about looking forward. What have you learned from this? So things like paid sick leave, which, unfortunately is not a federal right in the United States. Things like that, which previously when we talked to companies about it, well, it's a good benefit to have, right? It's good for the worker. Well, now it's good risk management. It's good for the enterprise as a whole, because in a pandemic, if people are coming to work sick, your workplace can become a disease vector. Your consumers could be getting sick when they're coming in the door, right? So we can start thinking about some of the issues we've been raising in the past a little bit differently. And it's so much harder, I think, for companies to deny that these are critical issues and that these are issues they really need to think about. In terms of executive compensation, there were some, major stories in the New York Times and the Financial Times about executives being granted significant special options grants at the bottom of the market. The market tanked, boom, they got millions of dollars in options, and a week later, they're beyond in the money, right? At the same time that they're laying people off. Now, investors have an opportunity to say something about that. Now, we have an advisory vote on executive compensation. We don't get the absolute yay or nay, but that's influential. And I hope that investors are going to be looking at that and raising really hard questions with those companies that kind of took advantage of the crisis. And I'll stop with one more big idea that I think has come up over the course of the past year, which was one that's proposed by Leo Strine, former Chief Justice of the Delaware Supreme Court. He co-authored an article about more equitable gain sharing across the corporate enterprise. So we all know the CEO takes a huge piece of the value home, but didn't create all that value, right? You need to rely on a huge workforce to do that. Maybe the compensation committee should have a broader mandate. And maybe the compensation committee, when they reward the CEO, should be thinking about how the typical worker is rewarded and seek to start to balance that. So it's a way to get to that wealth inequality question that's so hard to address. So it's been interesting in every sense of the word.
Thanks, Adam. Really, useful insight from both you and James there. Let's go to you, Chris, because these are the issues that investors are looking for. Investors want to know more about. But how do we give investors the tools so that they can effectively make decisions based on these ESG factors?
Yeah, that's a challenging question, one that I think a number of organizations have been trying to address. I think it has to start with reporting and disclosure at the corporate level. So, corporations are required to disclose a good deal of information about their financials in their financial statements. Now, over the last several decades, that information actually has become less and less of the overall information that investors and analysts use to make decisions. They continue to look to other types of data sources, other types of disclosures, third-party information, to analyze how a company would perform today and into the future. So we need to start by looking at that information, and I think there has been a lot of good progress. I'd start by commending the efforts of SASB and GRI and IRC in taking the lead to start standardizing those types of disclosures, as well as the efforts of TCFD, taking the environmental and climate change perspective. And I think we've seen really nice movement too with the IFRS stepping in and offering to bring those different efforts together. And again, I think we should commend all those organizations for being willing to come together and partner so that there can be more harmonization across those standards. Because frankly, unlike maybe financial information that can be standardized maybe a little bit more easily across industries, what you have when it comes to environmental, social, and governance type data, it's a bit more heterogeneous. And so you might need to have different standards or different metrics for different industries and different types of companies. So I think it has to start there. And again, we see different speed of movement on requiring that type of information in different parts of the world. Certainly, I think Europe is more advanced. We're certainly talking about it here in the U.S., and I think some recent developments, I think lead me to be more positive that we'll see more traction on that front in the coming years. And I think globally, it's a lot of other countries are interested in this. So I'm optimistic that there will be some more standardization. And then from certainly individual investors could use that information, but professional investors who then buy assets and package those into products, right, will probably start to pass on that type of information to the end investor, to retail investors. I suspect that we'll see increased reporting, increased metrics about the composition of the holdings in different products. We're not there yet. But I think investors should continue to make their wants and needs known to managers, to corporations about the kind of information that they want and need, both to make the upfront decision as well as to monitor performance over time. Okay? And that feeds into the stewardship type activities that Adam does. So I think that's really important. And again, it flowing across that value chain. And that's why you see different organizations tackling different parts of that data value chain. So again, the organizations I mentioned earlier about that disclosure of data from the corporations to investors and other stakeholders. And again, our standard is focused more on then how does that information get from the professional investors or the asset managers of the world to their end clients. So I think that's, it's tough. There's a lot of parts to figure out, a lot of nuances and challenges in how that data is defined and disclosed and communicated across a very complicated ecosystem.
That's absolutely right. It's something for us at the PRI that we're really hoping the new administration, the new Securities and Exchange Commission, is going to get to work on pretty quickly. We think it's really important. And what we hear time and again from the investors that we talk to is they need consistent, comparable data so they can, integrate it effectively and efficiently into their investment practice. We talked a little bit earlier about the notion that ESG investing isn't just about risk management. It can also be about helping to channel private capital into more productive ways or into ways that help to address some of the challenges that we face more broadly as a country and as an economy. We've seen this internationally. We've seen a lot of the conversation around sustainable finance, a lot of the conversation and the conversation around COVID recovery very much tied together. We haven't seen that as much in the US. So I wonder if you guys have thoughts on whether ESG investing can or should be part of President-elect Biden's promise to build back better that we're hearing so much about. I don't know, James, do you have thoughts on that? Do you want to take a crack at it?
I think the Biden administration is communicating the right things so far. I mean, I think the question is, how can we execute on those particular things? More specifically, communicating the right things with regard to climate and a focus on climate change by recognizing the science and the need to actually work on it starting now, and that is a long-term project. So the communications are definitely right in that regard. And the positives that could come from that is that you satisfy America's energy needs without increasing the carbon output. And a second part of what the Biden administration is focusing on is, racial equity. And this is incredibly important because, I think historically, the U.S. has had a substantial problem with not considering the rights or the humanity of certain segments of society. We see it in that it's hard to look at an American city and not see former predominantly minority neighborhoods have a highway run through it. Or we see it like within the Dakota Access Pipelines and not considering the rights of the tribes that would be impacted by an infrastructure project. The thought being that the high-level statement that's made by the Biden administration seems to point that there will be considerations for those types of issues. But the focus is still on being productive, but it's being productive for all of Americans and not just for those at the very top end of the income scale. And I think what's left to sort out, though, is that how do you execute on those high-level statements? And I think those of us who have been focused on sustainability, I think, show that there is a route that you can meet those high-level statements while being productive within an economy and ensuring that it is definitely more inclusive because all people within the economy are considered when decisions are made, and you can have projects that consider these people and are in part beneficial to them. One specific thing that the Biden administration is focused on is that you'll have infrastructure projects, but 40% of those will be focused on underserved communities. And we don't know the specifics of how that might turn out, but the assumption is that that means jobs for those communities, additional services within those communities, and a better lives for the people who live within those communities. And hopefully it doesn't mean that you are substituting citizens who live in a particular area, moving them out, and then moving in different citizens to live in the same community, which we've also seen in many cities, which I think on a long-term perspective isn't productive, especially when government resources are actually being expended to make that change in preferred citizens. So I think the Biden administration is actually saying the right things, and the hope is that the execution is in line with those high-level statements.
Yeah. Very good point. The execution needs to be in line with the high-level statements. I noticed we have an audience question, or a question came in from the audience about that statement we referenced that the ICI made earlier this week about standardized ESG disclosures. Adam, as a market participant, your organization may even be a member of the ICI. I wonder if you have a view as to the significance of that pronouncement from the organization earlier this week.
That is a big deal. The ICI is the trade association for the mutual fund industry, for those who are not familiar with it, and that's a very large industry, and they have a lot of influence. It's a major change. I mean, if you think back, I'm going to lose track, 16, 17 years ago, on the whole fight over mutual fund proxy voting disclosure, which now is like, oh, big deal. Who cares, right? Easy. ICI was very much against that. To see them move from that kind of a footing to mandatory sustainability reporting is really, I would not. Development. I mean, to get what Chris was saying, it all comes down to disclosure. It's the lifeblood of the capital markets, and if we can't get the information that we need to allocate capital appropriately and to allocate capital in a sustainable way, it just holds everything back. So we can get some good baseline standards in place. That will accelerate everything that we're doing. Perfect, Heather.
All right. I'm conscious of the time, and my 7-year-old has an urgent Candy Crush question. But if we could give everybody 30 seconds to make some closing remarks. Chris, let's start with you.
Yeah, well, thank you. Thanks again for the opportunity. This was great. I think my parting comment would be the ESG investing is, I think, all about investors having the opportunity to vote with their pocketbook. I think about how I used to go buy coffee in the grocery store, and it was I would think about the flavor and the price. But now I can look for labels that say if it's organic or fair trade or something, and that I think represents consumers becoming more sophisticated and using more, incorporating more of their concerns in their decision-making of what they choose to invest in or purchase. And I think that same trend is now happening in the investment management industry. And capital allocations decisions are powerful, particularly when they are undertaken by lots of people. So I think we can change the world as investors. You just have to prioritize your ethical needs along with your financial needs when you make decisions.
Yep. Very good. Adam, and we'll give James the last word. I think we have around 30 seconds left to close it out.
I'll be I agree with what Chris said. Look, every social or environmental issue that you're worried about, that you're working on, touches the capital markets, and the capital markets touch those issues. So when you're thinking about those issues, you're thinking about policy, prescriptions, and solutions, don't forget investors. Companies will tell you that they are serving their shareholders. So a lot of what they're doing is because of the signals that we're sending to them. And if we're not sending the right signals, we need to hear from our investors about that. So keep us in the loop, keep us in the conversation. Investors have an important role to play.
Great. Last word for you, James. Over to you.
So I can go back to the title of the program. Will ESG investing promote a more productive and inclusive economy? The answer is yes. It will do this by involving more people in the economy and by making certain that the primary risks aren't do not burden just certain segments. So it's an exciting time, and it's great to be in this space at this current time. And the primary thing now is, how do we execute on the great work that we've been doing over the last decade?
Very good. Thank you, James, Chris, and Adam, for joining me for this conversation. Next, we will take a quick break and be back shortly with a conversation with CFA's Barbara Roper and SEC Commissioner Caroline Crenshaw. Thanks, everyone.
Thank you.
Thank you.
Thanks.
Thank you, Heather Slavkin-Corzo, James Andrus, Chris Fiedler, and Adam Kanzer for an outstanding pros and cons of the pitfalls of ESG investing. Next up, SEC Commissioner Caroline Crenshaw, who will be introduced by CFA's longstanding Director of Investor Protection, Barb Roper, who incidentally put together our ESG panel. Barb is nationally known as America's leading protector of investor rights and has been fighting for investor protection for years. In doing so, she has become a turn-to source for consumer investor protection by regulators, public policymakers, the media, and even the industry. Barb?
Great. Thanks, Jack. And thanks to all of you in the audience. It is my very great pleasure to get to introduce our final speaker for this year's Virtual Financial Services Conference, SEC Commissioner Caroline Crenshaw. Just a few months into the job, she's already emerged as an important champion for investors, fighting to ensure that our markets are equitable, efficient, and transparent, and that investors are treated fairly. Commissioner Crenshaw had a distinguished career as a member of the SEC staff before being appointed as an SEC commissioner last August, including stints in the Division of Investment Management, which is the division that oversees investment funds and investment advisors, the Office of Inspections and Examinations, and the offices of two recent SEC commissioners, Kara Stein and Rob Jackson. I got to know Caroline well when she was working as counsel to former Commissioner Jackson. It was quickly apparent from our work together that she brought deep securities law expertise to the job. No big surprise there, along with an amazing work ethic, necessity in a very demanding job, and a truly impressive command of policy details. What is rarer and even more important is that she approaches the job with a genuine, passionate commitment to serving the public interest. We at CFA and in the investor community more broadly were therefore delighted when she was confirmed by the Senate last August in that new role. She has quickly distinguished herself as a champion of the ordinary Main Street investors who are least able to fend for themselves and most in need of a regulator who is always on their side. I'm therefore thrilled that Commissioner Crenshaw has agreed to participate in a Q&A with me today. Unfortunately, because she has another event immediately following this one, she won't have time to take audience questions. I'll do my best to ask the questions that I think you'll find of interest. So welcome, Commissioner Crenshaw.
Thank you. Extremely kind introduction. I'm more than flattered, and I'm thrilled to be here. Thank you.
Well, we're thrilled to have you. So let me start with a question on a topic that has come up repeatedly in this year's conference. I think understandably so. So from our current vantage point, nearing the end of this extraordinary, tumultuous year, a year marked by both a raging pandemic and powerful new evidence of systemic racial injustice that continues to mar our country, we've heard from several speakers at the conference about different ways that we can use the tools of finance to help build an economy that is fairer and more inclusive and more resilient. So I'd like to start by hearing your thoughts on what can be done through this sort of special lens of the regulation of our securities markets to promote these goals. How would you like to see the Securities and Exchange Commission approaching those issues in the coming year?
Well, thank you again, Barb. It's great to be here. I really appreciate it. And that is absolutely a critical question. Before I answer, I must say the standard disclaimer that the views I express today are my own and do not reflect the views of the commission, its staff, or my fellow commissioners. And I'll say that the challenge and perhaps joy of being last in an event like this is that you've already discussed so much. So I'll see if I can cover something new. And if you've covered this already, well, I hope you'll indulge me just the same. The focus of this year's conference, I think, like this question, is critically important. An economy that is more fair and inclusive, more equitable, is inherently more resilient. Structural inequities and imbalances in our financial markets and what we can do to dismantle them are absolutely top of mind for me. And through panels and other discussions, I see you've touched on a variety of the structural inequities that exist throughout our financial system, from the racial wealth gap, discrimination in credit and insurance, and fair housing. The breadth of the problem is significant. And I think there's no quick fix, but we are all committed to addressing these problems. So I would like to see the agency move quickly and actively to seek input on the ways our rules can be used to undo the injustice and the racial inequality that is built into the structure of our financial system and has limited the participation of historically underrepresented groups for just far too long. And as an example, I think one area that I would like the commission to focus on, one of many, but one is promoting board diversity. And I was pleased to see this proxy season, investors continued to call for increased board diversity. And as you know, NASDAQ recently proposed a rule that would push for board diversity at companies listed on the exchange. So I'm interested in hearing about additional steps that the commission could take to promote board diversity, and how that might also promote more equitable markets. And I think, for example, some of the things I'm thinking about are there steps the SEC can take that would promote more turnover of board seats? Would that create more openings and provide opportunities for companies to fill more board seats with diverse directors? And also, in addition to that, should the SEC enact specific disclosure requirements concerning the diversity of an issuer's workforce, management, and board composition? And I know there are lots of other questions that we need to be asking on this subject, and there are structural inequities in place too. So these are just a few of the things I'm thinking about, and I would look forward to feedback and engagement with everyone on these issues.
Great. So you talked about the structural inequities, and part of that we see in sort of the let's say the lily white nature of many of the boards of our major companies. But we can also see it in other aspects, the lack of representation of minorities, say, in the ranks of the financial professionals that we rely on, the difficulties that minorities and women face in getting access to capital for their businesses. So I was wondering, are there areas in some of these areas where you think the commission has the capacity to address this problem? Or is this an area where we're sort of so new to thinking about it in this way that we really are sort of at the stage of inviting in people to present new ideas?
So first and foremost, I'm open to any and all ideas. But specifically, I'm referring to structural issues that drive the lack of diversity on boards. The starting premise, I think, so to speak, is that, as you've alluded to, the boards of the 3,000 largest publicly traded companies remain overwhelmingly white and male. And this lack of diversity on corporate boards is just one part of a bigger problem. For example, while the world has changed, our financial system has consistently offered investors more opportunities to invest in businesses owned and advised by white males, and fewer opportunities to invest in businesses owned and advised by women and minorities. And there are fewer women and minority-owned businesses, which flows in part from the greater challenges those businesses face when seeking funding and investors as compared to white male-owned businesses. And so one of the structural obstacles to greater equity that we've been pointed to is the historical underrepresentation of non-white and non-male investors. We hear about underrepresented founders who repeatedly find themselves pitching to investors who regularly invest in white male entrepreneurs. This resulting sort of pattern matching, I think, can lead investors to unconsciously prefer to replicate what's familiar to them because it's perceived as successful. So I think one of the silver linings of 2020 is that there is an increased national focus and recognition of the ways our economy fails to serve communities of color. And I'd like the Commission to take a leading role in engaging on this subject. We need to elicit feedback from different groups on how we can break this cycle of inequality and change our institutional framework. And I think we could and should hold a series of roundtables to solicit feedback on the structural inequities present and the actions that the Commission and others can take to address them. So I think we should also solicit feedback on the questions to ask through this process. But a few of them just briefly come to mind for me, including how do we improve access to funding for historically represented groups? And as part of that, how do we encourage broker-dealers, fund managers, investment banks to facilitate offerings for those groups using their networks? And can we increase diversity among portfolio managers? Would that make our markets more inclusive of women and minority businesses? And finally, are there ways for the Commission to encourage institutional investors, public funds and large private institutional investors, to allocate investments to more businesses with women and minority founders? I know you all here today have spent a lot of time on these issues, and I do have an open door policy and look forward to hearing from you and engaging with these issues moving forward.
Thanks. And I just can't tell you how refreshing it is to hear a discussion of access to capital and improving access to capital that doesn't start with a list of rules we need to get rid of to make that happen. And I know from having worked with you and from having read your statements that you understand that we can, in fact, must promote sustainable capital formation without that kind of regulatory rollback. And which sort of leads me to my next idea. So you were sworn in August as a Democratic commissioner in a Republican administration. And you've taken a lot of partisan votes in the last couple of months. Well, in a little over a month, President-elect Biden will be sworn in. Presumably, his appointee to the chairman's job will bring a very different regulatory philosophy to the oversight of our securities markets. Are there particular policy changes that you think we should expect to see in a new administration?
So I'll caveat my response by saying that much of the agenda setting obviously will be up to that incoming chairperson. But with that said, I wouldn't be surprised if the next chairperson were to take a hard look at some of the issues that are on your minds. For example, the Commission's approach to ESG disclosures, and especially those focused on climate risk. And I understand there was a panel discussing ESG disclosures. I share your concerns about the inadequacies of a voluntary sustainability disclosure framework. It does not produce reliable and consistent and comparable information. So given the consensus that climate change will indeed have a significant impact on our financial system, I wouldn't be surprised to see a renewed focus on our modern disclosure system and what investors are and what improvements are needed to satisfy investor demands for this reliable and comparable and standardized set of disclosures. And as you know, I've also issued a couple of statements about the need for more specific human capital disclosure requirements. I think COVID-19 has emphasized the need for clear disclosure on workforce management. So I wouldn't be surprised either to see a focus on improving disclosures there too.
Terrific. Yes, I think that is one area where I certainly expect that we'll go from policies that discourage ESG investing to those that are more likely to encourage them, and to encourage, really meaningful, giving real meaning to those terms. So I want to shift to a topic that's near and dear to my heart. And if I'm remembering correctly, maybe the first topic I talked to you about when you were working with Commissioner Jackson. So I guess you know where I'm going. That's the regulation of the financial professionals investors rely on to help them navigate the difficult decisions regarding how to save and invest to afford an independent and dignified retirement, or buy a house, or pay for a child's college education. So as you know, so-called regulation best interest went into effect last summer, promising to ensure that brokers act in customers' best interests when recommending securities, and purporting to limit the harmful impact of conflicts of interest on the recommendations that they make. Groups like ours were extremely critical of the rule, and in fact, its only support came from the brokerage industry and others who had previously opposed regulation. So fair warning, now with the SEC under new leadership in the next year, we're going to be pushing the Commission to revise Reg BI and the related Investment Advisors Act guidance to ensure that it delivers the promised protections. Do you have any thoughts on how that can be achieved, where you would want to start on that?
Where to start? Yes. So first and foremost, I'm sympathetic to the concerns that you have just raised. I think a strong fiduciary standard of conduct that clearly requires investors to come first is critical. And that should be true whether the investor is working with their broker or with their investment advisor. That said, I think we need to start with an understanding of what, if any, impact regulation best interest is having on market practices and investor outcomes. With those results, I think we can more effectively plan next steps. I think we work towards answering those questions by gathering data. That's something that OC, our Office of Compliance, Inspections and Examinations, sort of the group that's the boots on the ground at the agency, has indicated it would be doing. And I think FINRA, the state securities regulators, and our Office of the Investor Advocate have certainly a role to play here as well. And I think we need data to answer these questions. So how is regulation best interest being implemented by firms? Are they actually changing their policies and procedures? Have these behaviors changed as a result? For example, are portfolios and recommendations changing? Are they more in line with investor objectives? In addition to those questions, I think specifically it's important to look at how conflicts of interests are being treated, what mitigation procedures are in place, and are those procedures working? And then also, I think we need to consider what quantifiable metrics we need to answer all these questions. So this is information that's critical to me. In short, I want to understand whether investors are getting the information that is actually in their best interest. And further, I think we really need to conduct investor testing around Form CRS and conflict disclosures. I'm interested to understand if they are serving their intended purpose. Are investors actually reading them? And for those who do, are the forms helping investors make informed investment decisions when they're selecting their financial professional and financial services? And as I've said, I think with that data in hand, we can elevate next steps. I expect whatever the outcome, I think we will likely need to issue guidance in this area.
Completely agree. And I certainly agree that we need to begin early to collect information about what's happening in the marketplace, and that there's a productive partnership that can occur between the Commission and the states and FINRA to collect that data, I would encourage you to consider that there are two areas where we don't really need to wait. And one would be in defining best interest, and the other would be in providing greater clarity around how the Commission interprets the requirement in the rule to mitigate conflicts of interest.
Yep.
And I think if we, I would suggest that if we can clarify the meanings of those terms and the Commission can start to enforce to those sort of standards, then you actually have the capacity to get some real benefits out of the rule, and may even deliver evidence that is being implemented in more effective ways.
I stopped short. What I didn't go into was that I completely agree, and the areas of potential guidance that I think are forefront for me are exactly what you just mentioned. What does best interest mean, and what is appropriate conflict mitigation? So those are absolutely questions that I am thinking about.
Wonderful. Look forward to having more conversations on that topic. As you know, one I can talk about endlessly. So I want to peg off of something, tie into something that you just mentioned in terms of the need to test the form CRS. And for those in our audience who aren't familiar with the shorthand, that is the new brief, supposedly plain English disclosure that brokers and advisors are required to provide to all of their prospective clients. It was adopted by the Commission without testing prior to being put in the field. And I haven't read a ton of them. I've read enough to know I've got some concerns. But I think that idea that you mentioned, that we should be testing those disclosures, and not just Form CRS, but this broader set of disclosures that retail investors rely on. We have decades of research that tell us that investors struggle to understand those disclosures. That's the bad news. We have good research that tells us there are concrete things we can do that make it easier for investors to understand them, more likely that they'll read them. So I would be interested in your thoughts about, beyond sort of Form CRS, are there ways that you think the Commission could incorporate that kind of testing into its regulatory approach?
Absolutely. I'd like to see the Commission employ qualitative disclosure testing. In addition to these two areas, I think we certainly need to look at testing disclosures more broadly. We need to understand across the board how investors are reviewing our disclosures, what information they find useful, what information they understand, what they don't understand. And I think that's a key step forward as we are taking a comprehensive look at revising any of our disclosures. And so I would look forward to working with our Office of Investor Advocate to help engage with investors and to find out what information they need, how they're interpreting these existing disclosures, and whether and how, I think how being the more operative word, they could be improved to increase understanding. Because I think as we're shifting to sort of individual investors having to rely on themselves for their investing, for their retirement savings, making a lot of these decisions, in addition to making sure that the advice that they're getting, sort of as opposed to their companies, I should say. So as they're looking to choose their investment advisor or their broker dealer, they need to be confident that that information is in their best interest, and they need to be able to look at the same information and understand it. So for me, it's critical that investors understand this data, and we won't know unless we actually test it. So that's certainly something I would look forward to trying to undertake.
Great. So we have just a few minutes left because I know you have a hard stop to get to your next event. So I want to just give you one. I asked you earlier about areas where you think we might see different policies. I want to just give you one more chance to talk about sort of what are the issues that are near and dear to your heart that you'd like to see the Commission address in the coming years.
So I'm hopeful that the next chairperson's agenda will be a little more in line with the issues that I am focused on. And I could go on and on about what I'd like to prioritize, but as you mentioned, we do have limited time. So in addition to what we've already talked about, I'll leave you with just a few additional areas of interest. One, I'd like to make sure that we're using data effectively. This is something I've been talking about, but for example, I think we have great staff in the Division of our Economic and Risk Analysis, or DERA. I'd like to make sure that they get the data that they need, and better data will allow DERA to continue to and perhaps have an even greater involvement in informing policy initiatives at a very early stage. And to the extent that commenters are relying on data, it's always helpful when commenters are transparent about the data that they rely on and consider providing us with access so we can engage with the analysis. Your comments are extremely important, and we want to be able to fully consider them. We do read footnotes, so please keep them coming. And two, in recent years, the Commission has focused on, and Barb, you alluded to this, making changes to the private markets and expanded access to them. I'd like for the Commission to focus more of its attention on the public markets and what can be done to improve and expand access to the public markets. I think this issue is extremely important for both our markets and for investors. So those are just two that I'll leave you with. I could go on, but I'll leave you with those two for now.
Perfect, thanks. So I am afraid we are, in fact, out of time. I've really appreciated your taking the time to speak with us today and your thoughtful comments. They are refreshing. I am sure our audience can see why we at CFA are such big fans. So thank you again, and I'll turn it back over to CFA Executive Director Jack Gillis to close out the conference.
Thank you, Barb.
Well, thank you as well, Barb Roper and Commissioner Caroline Crenshaw. Again, another public servant who is truly dedicated to actually serving the public. Well, our first ever virtual financial services conference has come to a close, and I want to thank the hundreds of advocates, media, industry, and public policy makers who joined us for the 33rd year of this event. A very special thank you to those organizations who made substantial contributions to this conference and served as part of the advisory committee. Again, they are listed under the advisory committee tab. While we may not see eye to eye on everything, all of these organizations have made the choice to support the Consumer Federation of America in our relentless fight to protect the American consumer. As I've said before, going forward, we must overcome division and travel together, not being afraid of compromise, but never conceding when it comes to protecting the American consumer. This event and all the work that CFA does would not have been possible without our more than 250 member organizations working at the national, state, and local level to serve as the consumer voice informing public policy. In fact, one of CFA's greatest strength is its diverse and effective members, representing literally tens of millions of consumers throughout the nation. We hope you'll join us in this fight by visiting our website to find out more about becoming a member of CFA. The amazing array of political leaders and policy experts that we've heard from during the past 2 days would not have been possible without the efforts of an incredible CFA staff. A special thanks to Conference Manager and Program Organizer Anna Marie Laurie and CFA's Legislative Director and General Counsel Rachel Weintraub, as well as Rachel Gittleman, Barb Roper, Barry Zegas, Doug Heller, Mitria Wilson-Spatzer, Richard Ekman, and Nick Roper, who worked tirelessly to make this event a reality. As we close out this event, you will be directed to a page that has a link to a survey to let us know, honestly, what you thought of this year's conference. You taking a few minutes to let us know your thoughts will be of great value to us. Let me just close by saying that I hope you share the fortification, inspiration, and hopefulness that I feel after listening to the over 25 public policymakers, public servants, advocates, and influencers during these past 2 days. Indeed, we have enormous hurdles to overcome, but the insights, thoughtfulness, intellect, and dedication of the people we have heard from leads me to believe that we will meet these challenges, that we will create a more just and equitable financial marketplace, and that we will open the doors for those Americans who for too long have been shut out of the system. But it is absolutely imperative that we all work together to seek common ground and remain steadfastly focused on eliminating the systemic injustice faced by way too many of our fellow Americans. And each and every one of us must join together for this effort to be successful. So until next year, when we hope to see you all, thank you very much. Stay well, wear your masks, and take care of each other.